I'm Marella Fernandez. Thanks for joining us today on Market Call. Brian Madden on the show with us today. He's Chief Investment Officer at First Avenue Investment Counsel. They'll take your questions on North American Equities. Here's how to reach us today, 1-855-326-6266. If you want to call in, you can email as well, marketcall@bnnbloomberg.ca. Brian, good to see you.
Likewise.
So markets are in the green in North America so far on the day, despite Donald Trump with yet another action that could be turned around at any point. We don't know. But why do you think that is? Are investors just ignoring trade threats at this point?
Yeah, look, Marella, we know the president is a petulant infant. There's a long established fact pattern in support of this. And today it's the Doug Ford, Ronald Reagan ad campaign. Next week it's the World Series, and you can bet dollars to donuts. It'll be something else the following week. So as investors, what we want to do is tune in the signals the market is giving us and tune out the noise. And so all this Trumpian sound and fury signifying nothing, just turn it down or turn it off. And I think investors are learning that lesson, and the markets are trading accordingly. Okay,
let's talk about earnings coming in. What have you noticed or seen so far as to how it bodes for the end of the year for equities in the markets?
So we have seen a good flurry of earnings out of the U.S. The S&P 500 companies, about 20% of them have reported their results so far. Notably, we've seen the big money center banks, some of the regional and super regional banks, some of the tech names, although notably we're waiting on most of the Magnificent Seven reporting next week. But early indications from the U.S. banks, things are looking good, and ditto in the other sectors, some of the consumer and industrial names. And we're just starting to get a trickle of results coming out of Canadian companies, but expectations are high. And so, it looks pretty good going into year end.
Okay. The budget also coming up, November in the early part, the 4th. What are your expectations?
Well, this is a really important budget. I know, of course, we always say this, and they're all important, but this one particularly, is a budget where Canada, the government, really needs to meet the moment. And so it's going to be an important budget. We're seeing estimates from private sector economists who are stealing investors to brace themselves for a pretty big budget deficit, something in the order of $80 to $100 billion. So these are levels of deficits we've really not seen outside of those couple of years of COVID when there was federal largesse everywhere. So it's going to be important. We're going to want to see, first of all, some indications that the government is realizing efficiencies in sort of the day-to-day business of running the government, because, of course, there are ambitious plans to make commitments to fund the military, meet the NATO commitments. And we're also hopeful that we're going to see, incentives to crowd in private sector investment, which is something Canada badly, desperately needs, productivity and prosperity enhancing investment. So, that's coming down in about 2 weeks' time. So I think to the extent we have an ambitious and well thought out budget, it could alleviate some of the pressure for the Bank of Canada to cut rates more aggressively than they might otherwise need to. And it may, in fact, shore up some support for the Canadian dollar as well, which, is up year to date, but it is lagging all of its G10 peers in appreciating against the U.S. dollar. So lots to watch for there in early November.
Okay, let's take a quick break. We'll line up some phone calls and emails for Brian Madden, First Avenue Investment Counsel. He'll answer your questions on North American Equities. Here's how to reach us. Back in a moment. Welcome back. We're going to start with an email from Hack. He has a question for Brian Madden. He says, thoughts on TransAlta? Okay, let's start with TransAlta.
Sure thing, and thank you for the question. This is, as investors may know, a big electricity generating utility, roots in Alberta, and still the majority of their operations are there, but they have branched out and have a presence in the United States, and a very small presence in Australia as well. We don't own this stock. We wouldn't be particularly interested in buying it. We do own a U.S. utility. Generally, when you invest in a utility, you get a stable and growing dividend. This company is endeavoring to grow the dividend, but it's a pretty low yield. It's about 1.1%, which is a real low side outlier among utilities. More typically, you'd see 3, 4, 5%. And it should be noted that this company cut its dividend by 78% back in 2015 and has sort of been ratcheting it back upwards since then. It's not profitable on the bottom line, which is also anomalous for a utility. It's fairly highly leveraged at 5 turns of debt to EBITDA. That's not unusual. It's not an investment grade credit rating. It's BB+. So it's just not a great exposure in terms of utilities, and we have better ideas, so wouldn't buy this one.
Okay, let's get to our first caller for the day. It's Michael in Vancouver. Hi, Michael.
Hello, Marilla. Hello, Brian. Brian, thanks for taking my call. Brian, a long-term holder of TC Energy. It's basically down here around $70. It's lost about 10% in the last month or so. And I just wonder what your thoughts are on TC or TRAP, and what your, briefly, if you could give me your strategy on your pipeline strategy. Do you own TC? Do you own Pembina, Enbridge, or Keyera? I'll hang up and listen to your response. Go Jays, go.
Okay, thank you for that. So energy infrastructure company, TC Energy, do you like them?
We do, in fact, and thank you for the question, Michael. So our pipeline strategy, you've identified it. We own one and only one pipeline company, and it's this one. We obviously like the huge gas pipeline network that they have in Canada and United States and Mexico. This is a strong, investment-grade credit. It's got a good path to growing the dividend at a mid-single-digit pace. The yield is certainly much higher than the other utility we talked about, and the pullback, we think, is a pretty good opportunity to accumulate the shares here. It's one that we've owned for quite some time in our portfolios, our dividend growers mandate specifically.
Pullback from price of oil, do you think?
Yeah, not
necessarily.
No, not necessarily. Like it's spun off. SOBO is the ticker, so South Bow, which was the oil pipeline. So this one is more of a play on natural gas demand, which we think is going to be robust. And then there's also some other businesses, including a partial stake in the Bruce Power nuclear reactor. So not particularly affected by oil. And pipelines in general are sort of more contracted on take-or-pay basis, and so they're not as vulnerable to fluctuations in commodity prices per se.
Got it. Okay, let's go to our next caller. Lily is on the line. She's in Montreal. Hi, Lily.
Hi, how are you? Thanks for taking my call. My question is, it's about CGI. I have it since long time. I don't know what to do right now. Thank you for your answer.
Okay.
Bye.
Thank you for the question, Lily. Let's have a look at the chart for CGI. It's at 123. It's been climbing or sort of falling down since the start of the year, pretty much February, and actually took a dip in April and then kind of came up and kept going down. What's going on at CGI?
Yeah, thank you for the question, Lily. This is not a company that we own in either of our 2 equity mandates at First Avenue Investment Counsel. It's a business process outsourcing and systems integration and consulting company. They do a lot of business. It is a global company, of course, headquartered here in Canada. They do a fair bit of business here, but also big player in the United States. They've been making a series of what they call metro market acquisitions to sort of have boots on the ground in important regions in the United States because it's a nearshoring strategy, doing business with states, municipalities, and the federal government, both the civilian side and the defense side. It may be recently vulnerable to the U.S. government shutdown, but obviously, as we know, all government shutdowns end with reopening, so that's not really a valid long-term reason not to own the stock. Although we don't own it, we'd have no qualms about buying it. I've owned it elsewhere and at other times in my career. It's a pretty steady, stable grower. It's maybe missing some of the sizzle that investors are looking for in technology stocks these days. It's not really a buzzy AI story, and I think that's where the money is flowing to. But I think you want to take advantage of disinterest in otherwise good company and accumulate it on sale here. So no qualms about buying this one, although we don't ourselves own it at the moment.
Any reason for that dramatic decline over the year?
Well, as I said, I think it's got to do with money flowing elsewhere into sort of more AI-driven stories and companies with faster organic growth. This is not a rapid organic growth kind of a company. It's a low to mid-single-digit organic growth story. So,
would you advise her to hang on to it then? Do you see any upside for her?
oh, yeah, I think it's definitely something that you want to continue to own. It's been a very good long-term compounder over many decades.
Okay, we're going to take a quick break. Brian Madden sticking around. He's with First Avenue Investment Counsel, taking your questions on North American Equities. Back in a moment. Welcome back to Market Call. Let's go to the phone lines. John is calling today from Milford, Ontario. Hi, John.
Good day. Brian, I would like your general thoughts on the banks going forward. I've owned them since the 90s, and I've done fantastic on them. Can you see Royal or Montreal having a split anytime soon? Thank you very much. Bye.
Okay. We've talked, I think, in the past about whether or not Royal Bank would split. Is there a benefit for a company like Royal Bank to split?
No, not especially. You still will occasionally see companies splitting their shares. We own Brookfield, for instance, and it split 3 for 2 a month or so ago. I don't really have any special insight on whether Royal or BMO is going to split their shares, but I don't necessarily think it would be a particularly strong catalyst for the stock. In the old days, you used to trade shares in what they call board lots. So that's lots of 100. And the advantage to trading shares in lots of 100 or more was that you would get pricing at the inside bid or offer. And whereas if you bought 68 shares or 122 or something, you might get filled or quote priced outside of the quote. But that is less and less a factor now. We have penny increment trading. It used to be in 8s and 16s. So I'm dating myself there. It goes way back. And then the other thing was, making the shares accessible to small investors who mightn't necessarily be able to buy 100 shares. So now that's even less of a factor because there's various innovations in the ecosystem where you can buy fractional shares of companies. So I don't think the split matters. But to the broader question, we own Royal and BMO and TD as well, for that matter. They're cornerstone holdings in our dividend growers mandate for the very reason that banking is a stable and well-regulated tight oligopoly in Canada. It's very structurally profitable, competitive barriers to entry. These banks have grown ambitions beyond our borders. Both have big businesses in the United States. And are diversified by line of business as well. So things like insurance, the capital markets, or investment banking business are probably going to be gangbusters for all of the Canadian banks this quarter. And similarly, wealth management should be very profitable for them because, of course, these are fee-based businesses, and with markets at or near record highs, all that bodes well. The one fly in the ointment that we think is going to be a bit of a lingering headwind is tepid loan growth demand, particularly mortgages, and maybe to a lesser extent the commercial and industrial loans. And then there could be some lingering credit loss experience, although we think the worst of that is probably behind the Canadian banks, in the last couple of quarters. So, good prognosis for Canadian bank earnings and outlook for the shares here.
Okay, let's hope that helps out our last caller, John, and we will move on to Chris, who's in Delta, BC. Hi, Chris.
Hi, good morning, Morella. I'm in the process of moving, so I'm throwing you off from Victoria. Okay. Brian, I thank you both for taking my call. Pardon me, Brian. If I could please have your opinion on Tourmaline Oil. I know it's a company that you've recommended in the past. I've pretty well done well with buying every 5+% dip in this stock for the last few years, and I'm wondering if you see that still being a good long-term investment going forward. Thank you both, and have an exceptional weekend.
Thank you for the question today. Tourmaline, of course, into a natural gas play, which many do expect to be positive, but when, we're not quite sure when things will start to really kick up as far as getting the supply out and shipped out.
Yeah, well, this is just it. So thank you for the question, Chris. We own Tourmaline Oil. So, we like it. It's owned in our dividend growers mandate. Company pays a nice dividend. Interestingly, it's not just a regular dividend, but as you'll know, and will have benefited from, it pays sort of regular, irregular dividends. That's special dividends. So they don't not necessarily want to be beholden to a super high dividend payout because obviously there's volatility with their profits given that it's a nat gas commodity producer. But it does have a commitment to returning capital to shareholders via regular and special dividends. They've done share purchases as well occasionally. Bit of a change in strategy from the company was dribbled out to investors during the summer. A more ambitious than had originally been anticipated capital program, so that might throttle back some of these special dividends. But this is a company that is very good at capital deployment. Mike Rose, the CEO, has a lot of his own skin in the game, very large shareholder, founder of the company, and so it's unlikely that they would be making more aggressive and ambitious capital spending plans unless they thought they'd get good returns on that capital. And we concur. We think that producing, as they do in Alberta, it's some of the lowest cost natural gas in the world to produce. They have prolific resources. They're the biggest nat gas producer in Canada. They produce almost 3 BCF a day. That's about 13% of all the natural gas Canada produces. And to your comment, Morella, when are we going to get it to Tidewater and get it to overseas markets where, in Europe and Asia, the price of the commodity is 4 to 5 times higher than the Alberta hub price. We've got some glimmers of hope. LNG Canada started up in the summer. They had some growing pains ramping that up, but they'll iron out those kinks, and that is a very big export facility. And there's more on the drawing board, like Sea Limbs and other projects. Some of that is probably going to get debottlenecked and expedited with Mark Carney's initiative via the Major Projects Office. So long-term outlook for Canadian nat gas producers, Tourmaline particularly, is pretty rosy, we think.
Okay, let's hope that it's good for Chris as we move on to Kevin, who's in Toronto. Hi, Kevin.
Hi, Brian. Thanks for taking my call. My question is on Dye & Durham, D&D. I'm just wondering if I should cut my losses or you see a sale eventually happening. Thanks.
Okay.
Bye.
Dye & Durham, yeah, and CIBC just stepped away, I think, from Dye & Durham as an advisor. So I'm not sure how much that plays out in the day-to-day for Dye & Durham, but what are your thoughts?
Yeah, Kevin, this is a really interesting one. Obviously, this stock was, a superstar out of the gates when it IPO'd sort of in the early COVID era. And then it's kind of collapsed in a loud and messy way in the ensuing years. Obviously, the CEO was ousted, an activist sniffing all around this thing inside and out. And the ousted CEO, Mr. Proud, had mounted a takeover campaign and then walked away from that, I think, a week or so ago. I think at the end of the day, there's probably latent value here. The current management team is not really getting after surfacing it for shareholders. Somebody will. We don't own this. It's sort of a bit messy and complex for our investment mandates. But, I think if you're patient, somebody is going to find a way to surface the value here. Just don't really have a good line of sight to how it gets done and when. But probably the intrinsic value is higher than the current share price.
Would you hang on to it then if you had some shares?
Yeah.
Okay.
Yeah.
We're going to take a quick break. When we come back, we will look at Brian's past picks. That's coming up next. Welcome back. Time to look at past picks from Brian Madden. These are picks from last year, October, I believe, of last year, October 20th, 2024. At the time, Brian, you chose TFI International, TFI International, TFI I on the TSX, 189.95 at the time, down to 125.35 today. So 34% drop return, total return down 33%. This is a transportation company and was doing really well at the end of last year when you were picking it up. And then it's done this drop down at the start of the year. They're based in Quebec. I remember at one point they were going to take their headquarters to the U.S. out of Quebec, and people didn't like that. But I thought they'd get a bounce back sort of once the tariff situations were dealt with.
Yeah, so I mean, admittedly, timing was not great on this one. We still own the stock. We think it's one of the best trucking companies in North America, and it is North American in scope. The business is quite large in the U.S., bigger, in fact, now than in Canada. But remember, this is a serial acquirer. They've done something like 80 acquisitions over the last 10 or 12 years. Some small tuck-ins, others bigger and more transformational. The CQ was one that they did, I think, late last year, and the big one that certainly put them on the map in a big way in the less than truckload business in the States was they acquired the UPS freight business in 2020. But they're getting some indigestion integrating that and some of the other less than truckload businesses. They've shaken up the leadership of the less than truckload segment. We think that's going to bear fruit. The CEO is a very serious, sort of hard-nosed business person who likes things to run lean and efficient, have the right freight for their network. And so, if your team is not getting it done, you're
he's going to find somebody who can.
Yeah, so he's done that. And so, how long does it take for that to bear fruit? We're not sure. And in the background, the whole freight and trucking industry is in a situation of overcapacity, and so that's pressuring freight rates. So
too many trucks on the road?
Yeah, exactly. So, it's a totally, perfectly, purely competitive commoditized business. So the freight price is going to dictate their profitability. So we need freight volumes to come back. We need trucks to come off the road. That's going to take some time, but we think the long-term value and the compounding potential and history this company has had will reassert itself in due course.
All right. Let's go to your next past pick from October of last year. Broadcom, AVGO on the NASDAQ, 179.89 US at the time, now up to 354.18. You've redeemed yourself here. It's a 97% return and a total return of 98%. What has been going right for this semiconductor sort of software company?
Yeah, I mean, the first one was a strikeout. This one's a home run, so you can't win them all. But this one, certainly we've been pleased with how it's performed. It's a big semiconductor producer, the second biggest in the United States behind NVIDIA. It's big in artificial intelligence, sort of high-spec compute chips, but also makes chips for laptops and servers and other electronics, cell phones and tablets and the like. So those segments have been a bit sluggish, but obviously the sensational demand for AI computing chips has really been what's carried the day here. So we still like and own this one and see good long-run potential for it still.
Okay, let's go to your third pick from last year, Couche-Tard on the TSX, ATD. They were 73.73 at the time you recommended it. Now it's 73.25, so not a lot of movement. Less than 1% down and up a little bit for total return. They struggle to try and do some takeovers from a Japan owner-operator of the 7-Elevens, which we watched for quite some time. And then they haven't really bounced back to where they were at the end of last year. What's on the horizon for this company? Are you holding on to them?
Yeah, we are. So, this has been another just tremendous growth story and compounder for decades, starting from humble roots with one store in Laval, Quebec, to now being the second largest convenience store operator in the world. You're right, they didn't get 7-Eleven. We would have liked to see that get done. I think we're in a minority of investors that were favorable about that deal. Most people didn't give them the benefit of the doubt that this deal would be strategic and synergistic. We think it would have, but 7-Eleven just didn't want to play ball. That's not stopping them, though. They are still making acquisitions, albeit not as sort of elephant hunting in scope as 7-Eleven would have been, but doing sort of small and medium-sized acquisitions in the United States and in other geographies. We think it's increasingly likely that they may plant their flag on, another outpost, possibly in Latam or Mexico or something like that. And we also think there might be another chapter still to be written on 7-Eleven. The share price, the Japanese shares are trading well below what Couche-Tard offered. And the company says, trust us, we'll create value for shareholders. I think shareholders at some point are going to say, show me the money. And if they don't, Couche may get another kick at the can here. There's also talks that 7-Eleven may IPO its U.S. division. So if that doesn't go well, Couche-Tard could maybe just buy that and not have to deal with sort of the odd and archaic Japanese corporate governance system that they were trying to wrangle over the last year. So we like it. It's a great operator and a serial acquirer and consolidator in a fragmented industry.
Okay. We'll get back to your phone calls and your emails in a moment. Stay tuned. Welcome back. Thanks for joining us on Market Call. Let's go to Hank on the line in Winnipeg with a question. Hi, Hank.
Hi.
What's your question?
I was wondering if TELUS stock would be a good buy for its dividend. I'm looking for a little bit of dividend income.
Okay, thank you for the question. TELUS and telecommunication space in general have been pushed back. Do you like TELUS in the space? Do you know what the dividend is for TELUS?
Yeah, it yields 7 point something.
Okay, so it's a good dividend.
It is, yeah. So thanks for the question, Hank. We do own TELUS, bought it close to a year ago, and it's sort of clawed its way a little bit higher. It's not exactly setting the world on fire, but we've got other stocks that do that. We own this one for its dividend and for its dividend growth. So you get the yield, which is 7 point something, and then
I think it's 7.8. Yes.
Yeah, so it's pretty juicy. Historically, this has tended to trade more at a 5.5% dividend yield. So the share price is discounted. And of course, people will know there was a bit of a price war in the cell phone space, which drives the lion's share of the profits here, which ended up being worse than a zero-sum game. Nobody really won. They traded some market share and eroded the whole industry profit pool. The competitive intensity has abated, though. The headwind that the telcos are going to face now is that this is very much a per capita business. We generally have one phone. Some people have two, but you're not going to have 6 or 7 of them. So it's linked to population growth, and population growth is slowing with the federal government's curtailing of student and temporary foreign work permits. So, they just need to run leaner and efficiently and, compete effectively. We're encouraged by early signs of pricing rationality coming back into the cell phone space. I attended their Investor Day in Toronto last week, so that was a good deep dive I attended the BCE Investor Day, but it was a good sort of deep dive on the competitive dynamics in the telco space. We like TELUS because it's also got a nice array of other non-telco businesses like Morneau Chappelle, and there's home security and monitoring, TELUS Agriculture, and there's plans to monetize some non-core urban real estate. So I think these are unpriced catalysts that could get the shares moving higher in addition to the nice dividend that you do get from it.
Okay, let's go to Jack then. Jack's in London, Ontario with a question. Hi, Jack.
Hi. Brian, what's your idea of holding Google when it's already got up 85% the last 2 years? Would you hold all of it or would you take some off the table?
Okay, thank you for the question. There were questions about, the search engine and what will that do when AI is fully integrated and people won't maybe need Google anymore, but they've pivoted to other things.
Yeah, I mean, it is still very much dominated by online advertising and search. So it's going to be important that they innovate and compete and stay relevant in an era where, there's other ways of searching using ChatGPT and Perplexity and stuff like that. But as you noted, there's various other bits and pieces there. There's YouTube, and then they've got this Google Other Bets and Waymo and different sort of irons in the fire. Some of which could pay off spectacularly, some of them won't. But really, it is still all about search and also cloud computing. So that's another big part of it. So we like the collection of businesses. I think there's a broader question about portfolio construction. So you don't want to let one stock, you don't want to become a victim of your own success. So we own Google. We've owned it for a long time. We're going to continue to own it. But as a matter of prudent risk management and portfolio management, if a single stock comes to take up an outsized portion of your portfolio, you want to take some partial profits and reduce the single stock or idiosyncratic risk. It's not a vote against the stock. It's just a prudent way to manage a portfolio. So I don't know what weight the stock would comprise in your portfolio, but if it's sort of getting outside of your single stock comfort limit, you should take some partial profits.
Okay. Jack, I hope that helped you out. Let's go to David in Barrie, Ontario. David, what's your question today?
Hello, good afternoon to both of you. I'm just asking to the guest, please, about Enbridge. It's a buy or a sell. It's been down a lot. It's either that or Pembina. Thank you very much. Have a nice weekend.
Okay, thank you for the question. We will pull up our Enbridge chart there. It is down a little bit on the day. And it was, I think, closer to $70 at one point. It's $65.72. What's your take on Enbridge and any sort of return to a higher growth?
Yeah, so thank you for the question, David. We don't own Enbridge. We talked about the other pipeline company earlier in the show that we do own, which is TC Energy. So to differentiate the two, Enbridge is really has more oil exposure. TC Energy spun off their oil pipelines. That's now traded as South Bow Energy. Beyond that, Enbridge, Enbridge obviously has the huge natural gas pipelines, Canada and the U.S. There's also a renewable energy division, which is small. And then, of course, as folks in this region know, there's Enbridge and Enbridge and Union Gas, which is a local gas distribution utility in Ontario and Quebec. That's a very good, stable, well-regulated business. All of their businesses are pretty good, stable, and well-regulated. So no quarrel with owning this one. We do think TC Energy is a better idea, though, if you want to own a pipeline, but this would be probably a close second in our view.
Any reason you see for it moving down from the high end of September of 70 and change?
Nothing
obvious.
No, nothing really. Like it's TC Energy has a similar pattern, and so Enbridge has more oil export exposure. There were talks earlier. I don't know that they're going anywhere about firing up this Keystone XL project again. The original sponsor of that South Bow Energy, I don't think is particularly interested in doing it. So there could be some noise around that, but nothing really to warrant a pullback of the sort that we're seeing in either this or TC Energy. So good opportunities if you want to accumulate the shares.
Okay, good to know. Let's take a quick break. Back with more of your phone calls and your emails in just a moment. Welcome back. Thanks for joining us on Market Call. Let's go to Amin on the line in Thornhill, Ontario, with a question. Hi, Amin.
Hello. Thank you very much for taking my call. Brian, my question is on PE ratios for insurance companies. For example, Allstate. They seem pretty cheap compared to banks and other financials. Is this because of the bond markets, or just generally? My question is, why are they seem to be a little bit cheaper compared to other financials, let's say J.P. Morgan's and Bank of America? Thank you.
Yeah, I think what we will often do when we're valuing financial companies, because they're big balance sheet asset intensive businesses, we will sometimes value them based on their price to book ratios. And so the beauty of doing that, if you think there's an accounting identity, the price to earnings ratio actually can be decomposed into the price to book and the return on equity. So price to earnings is actually just price to book divided by return on equity. The advantage to valuing a financial company or any company really based on price to book is it tells you purely what are you paying for the value of the company's shareholders' equity. And then you can decompose and say the other part of the equation is what are you getting And so what are you getting is answered by looking at the return on equity. How profitable is that shareholder's equity? Coming back to this one, I think it probably trades at a discount to JP Morgan because JP Morgan is a better and bigger company with better structural profitability. Beyond that, I would say there are some stirrings in the property and casualty markets globally of softness, meaning premiums are not going to go up at the sort of mid-single digit to high single digit pace we've been seeing in recent years. There's more underwriting capacity coming into the market, leading to price competition, which may, in all likelihood, will depress insurers' profitability. So we'd be wary of this one and would prefer the banks.
Okay, let's get to our next caller. Gulam on the line, calling from Toronto. Hi, Gulam.
Hi there. How are you?
Good, thank you.
Okay, my question is on Interfor, IFP. I bought those shares years and years ago, and they were doing quite well until Trump put in some tariffs on lumber. And now I think that trading below my cost, almost breaking even, I would say. Where do you see the stock going? You see further upside on it? Should I hold or sell?
I think Interfor, thanks for the question, Gulam. I think Interfor also had to cut back some of its production as a result of the tariffs and shipments dropping off to the U.S. or unable to ship as much to the U.S. What's your take on the sector, first of all?
It's dreadful. Yeah. I would sell the stock, Gulam. I won't mince words. Lumber stocks have been really not a good buy and hold investment for the entirety of my career. That spans almost 3 decades now. Case in point, when I started in this business in the mid-90s, the TSX Forest Products Group was about a 4 or 5% weight in the TSX. It's now well under 1%, which means these companies are just sort of disappearing. This one, I would say there's no particular reason to own it. If you want to own a lumber stock, think of it as a trade, not an investment. Lumber stocks are never, ever, anywhere a good long-term investment, period, case closed. You can trade them, but you need to get the timing right, and the timing is right when the cycle is in an upswing, and you have an accelerating economy, housing starts are robust, and home rental activity is robust. None of that is happening right now. And then, if you need another icing on the cake, reasons not to own this, of course, you have the trade and tariff wars, and those don't look to be dissipating anytime soon. So would recommend you sell this one.
All right, Gulam, I hope that works for you. Let's go to William on the line from London, Ontario. Hi, William.
Good afternoon. Thank you for your past suggestions. How do I rate if I should buy BAM, Brookfield Asset Manager, please?
Okay, thank you for the question.
Great question, William. So actually, I just attended a Brookfield Investor Day and heard from some of their listed affiliates, not Brookfield Asset Management per se, but a good sort of look at some of the operating businesses within it. Brookfield Asset Management, Brookfield Corp has a habit of spinning out entities every few years. This one was spun out some years ago, 3 or 4, I think. It's re-domiciled to the United States, at least its headquarters. That's going to qualify it for U.S. index inclusion at some point in the future, which should lead to more demand for the shares. Here we're looking at a chart of Brookfield Corp. It looks like it fell off a cliff, but it's because of a 3-for-2 stock split. The long and the short of it is we own Brookfield Corp, and we feel that's a good way of getting diversified exposure to all of their operating segments. Brookfield Asset Management is another good exposure. It's sort of the third-party wealth management and asset management, which is huge, their biggest business. So we own it implicitly via ownership of the parent co, Brookfield Corp, but would have no quarrel with you owning this one directly, per se.
Okay. That is all the time we have for phone calls and emails. Brian will stick around and share his new top picks. That's next. Join us Monday on Market Call. Greg Newman on the show, Senior Wealth Advisor and Portfolio Manager, Newman Group, Scotia McLeod. He will take your questions on North American equities and dividend stocks. Time for new top picks from Brian Madden. We'll start with MDA Space, MDA on the TSX. MDA Space, Brian got a bit of a hit when it lost a contract recently, and it hasn't recovered very well, but this is a stock you are holding and you like?
Yeah, absolutely. And in fact, we bought it on that dip when they lost the EchoStar contract. We'd been scoping this one since May, saw the company at a conference in the spring. Some great work actually done on this name by our summer intern, Michael Charmatero, overseen by my colleagues and I. And so we'd been looking at it, but it was just running really hot, and we were being disciplined about valuation. And so we got the opportunity we were looking for to buy it on that pullback. And what we like about it is, although the chart probably only goes back 3 or 4 years because it relaunched after having been bought by private equity on the public markets around that time, it's actually been operating for about 55 years. And it's a leading Canadian space technology company. They manufacture low Earth orbit satellites. And so it's well positioned to capitalize on the $1.5 trillion global space economy. And there's really 2 aspects to that. So there's the telecommunications and mobility market, and then there's the defense opportunity. Both are growing. Defense may get sort of an outsized boost with more federal funding when we see the federal budget. The order backlog is just under $5 billion. That order book has compounded at 54% annually since 2020. Management themselves foresee 25 to 30% revenue growth over the next few years. And that's driven by conversion of their $20 billion plus pipeline that's been cultivated carefully through contacts in government and private sector over many years. And so although the stock has run up rather nicely this year, we think it trades at a fairly undemanding multiple of about 12 times enterprise value to EBITDA, which we think is pretty reasonable given the very rapid pace of growth we foresee in the coming years.
Okay, MDA is your first pick. Let's get to your next. Waste Management, WM on the New York Stock Exchange. This is a company that does what it says. It manages waste. But what do you see in as far as benefits or growth for this company?
So obviously, waste management is, not a want; it's a need. So it's a business that is not really ever going to be disrupted anytime soon. This is the leader in North America. Call it roughly a 25% market share in this $120 billion market. And so they have a wide competitive moat, and that is predicated on their ownership of about 260 plus landfills. And so the reason why that's important is because, as you might imagine, you have this whole not in my backyard phenomenon. It's extraordinarily difficult to get regulatory and environmental approvals to open a landfill. So they have that as an advantage, inherent in investment in the company. It allows them to lower disposal costs and to price more sharply for their collection contracts. So it's just a nice flywheel kind of benefit that they're leveraging. Beyond that, they also have a recycling business. So that's another sort of exposure that's growing perhaps a little bit faster than the collections and disposal business.
They're based in Texas, but do they operate in Canada as well?
Yeah, they're all over the place. So they operate in 49 states and in 6 Canadian provinces, so pretty good footprint. About 500 plus sort of waste transfer collection stations. And then they bought Stericycle just about a year ago. So that gets them into the medical waste disposal business, which is growing secularly faster than the core waste management business. Beyond that, they make sort of small tuck-in acquisitions here and there every year, buy back a lot of shares. And so, all of this rolls up to a high single-digit pace of organic growth, and then coupled with operating efficiencies and the odd acquisition here and there, we expect they're going to be able to grow their EBITDA or operating profit at about 10% and their dividend at roughly the same pace. And proof point here that management is good at what they're doing is the shares that have compounded total shareholder return at 17% over the last decade. And we see the pullback from the recent highs as a good entry point here.
Okay, let's get to your last pick then, which is Allied Properties REIT, AP-UN on the TSX. This is a company that does office, acts as the landlord for office and retail space. They sort of are in charge of what or operated or built the Well in Toronto, which if you live in Toronto, you may have heard of, which is an exceptional space. But what else do they do?
Well, it's a big landlord, of course, primarily office, about 85% office, some retail and some parking exposures. Across the country, I think there's about 13 million square feet of space, about 6 million in Montreal. And if your viewers are headed down to watch the big game tonight, you will be in Allied Property territory because this is a company that's best known for gentrifying and rejuvenating the King Street and Front Street corridors in downtown Toronto. They also have properties in Calgary and in Kitchener and in Vancouver, but mostly it's Toronto, Montreal. The stock is very discounted. It trades about half of its book value. The yield, the dividend yield, is close to 10%. So sometimes you see a dividend yield like that and you wonder, is it too good to be true? Are they going to cut the dividend? We don't think so. We've met management, talked to them. We've looked at all the financial metrics and have stress tested their resilience in paying the dividends. So we think the dividend is secure even if occupancy were to go lower, which we don't expect. Occupancy is running at 85%. So we see that sort of snapping back as banks and the government get back to the office. And in the meantime, while we wait for the shares to re-rate, good dividend yield. So, yeah.
All right, good to know, because that is a high dividend. That is it for Market Call today. We have to leave it there. Brian Madden, thanks for coming in.
Pleasure, thank you.
We'll see you again on Monday. Have a good weekend.